Lessons learned in 2013. Welcome to this week's edition of Friday's Food for Thought. Now, I personally don't agree completely with the adage, hindsight is always 20/20. Why is that? Because if we don't take away the teachable moment from our experiences, we lose out on the opportunity for perspective and growth. Now, beyond the top reverse mortgage stories for this year, there are some greater lessons for us to glean from what is sure to be noted as a watershed year for the home equity conversion mortgage program. So here we go. Here are the takeaways that we can consider for 2013. Number one, if it sounds too good to be true, it probably is. Now, economically, we can point to artificially low interest rates and government economic stimulus as short-lived events. We must remember that. Now, while the Federal Reserve has done what it deems to be necessary to prop up a faltering economy, it is unlikely that they will fully cease measures to inject more liquidity into the marketplace. This is because the American consumer has become hooked on the sweet sugar of cheap money. Now, as an industry, we can point to the extinct standard fixed rate loan. If anyone looked at the amortization schedule with a full lump sum withdrawal up front, one could easily see the increased risk of FHA paying an insurance claim when the loan ultimately terminates. Now, HUD's actuarial review of the Mutual Mortgage Insurance Fund a few years ago snapped us back into reality. Number two, it's perception, not product. Now, while reductions in the principal limit, higher FHA insurance premiums, and new underwriting standards will limit the loan's adoption, our biggest hurdle is public perception. And with a mere 2% of eligible senior homeowners having taken a reverse mortgage, we can safely say today that many of the 98% would qualify but are not taking action. The question is, why? Number three, change is constant. The English novelist Arnold Bennett said, "Any change, even a change for the better, is always accompanied by drawbacks and discomforts." So true. The survival of the HECM program hinges on its ability to change and to adapt to economic conditions. As the reverse mortgage expanded its reach during the mid-2000s and housing values crashed later in that same decade, HUD was faced to rework a program that had basically remained unchanged for over 20 plus years. Yes, since 1989. Now, the passage of the Reverse Mortgage Stabilization Act gives FHA the ability and the authority to act quickly and to enact product change and policy via mortgagee letter. Lesson number four, we can't be all things to all people. Now, quite frankly, those with little assets and who pose a risk of non-payment of property charges will no longer qualify. Now, for us to continue to serve eligible homeowners, we must avoid risky loans no matter how motivated the needs-based borrower may be. And fifth and lastly, successful originators are successful marketers. Now, those you know who are succeeding and maintaining and growing their reverse mortgage business this year have embraced marketing, and they're reaching out to new audiences, realtors, home builders, and especially financial professionals. These are largely untapped markets of future loans that require deliberate planning, promotion, and follow-up. Now, what lessons do you feel that our industry has learned in 2013? Share your thoughts in the comment section below, and have a great weekend.